Hi everybody, this is retired school teacher Sally coming to you today from Las Vegas, Nevada. I'm out here on a weekend trip for some training for a little small business that I have that I work during my retirement, and I also added an extra day on to have a little bit of fun while I'm in Las Vegas. So the training starts tomorrow and I will be pretty tied up for that, so I had to have my fun today while I was here. So I have been doing a couple videos, or I have a channel that I would love for you to subscribe to, and then you can also make sure you subscribe or click the bell so when I do some of these presentations you can be notified that I've put them on there. What I'm doing most of my videos on right now is how to prepare for retirement. As a school teacher, many of us haven't done the best job preparing, and I want to kind of give you some ideas of maybe some things that you can do. And last video I talked about paying yourself first and how important that is, that you put yourself on the list so you make sure that you are taken care of, because if you don't put yourself first, probably no one else will. So I want to talk about two different vehicles that you have the option of doing when you are putting your money away through a workplace retirement plan. As a school teacher, and almost 40 years ago, I only had one option. I want to explain what that option is. The option that I had was called a tax shelter program. So I wanted to shelter the tax during the year that I made the income, so when it was time to pay tax at the end of the year, my income was less and I was in possibly a lower tax bracket, or certainly had to pay less tax. That was the only option I had. Now, what I invested it in, that's a different video that I'll be sharing some things in. I'm only talking about whether I put it in a tax shelter program and then never pay any tax on it until I begin to pull it out during retirement. Basically, the school of thought with that is when you retire, you have less income pulling out of retirement funds than you have when you're working. So the good news is you're probably in a lower bracket. Somewhat true, but it all depends on what your income is throughout the year. And if you change jobs, if you get big raises, that's all pretty important. So the tax shelter means every single year I put my money away, my income is reduced. Now, I will have to pay tax on that. At all of the money that I put away, I do have to pay tax on it. So the other option that I want to share with you that I think is an excellent one, and it depends on what your income situation is, but it's also putting your money away through a workplace, but I'm doing it through a Roth. Now, as I said, I'm not actually doing that because I didn't have that option. But somebody that, as a person who's got a long work life ahead of them before they actually retire, if you can put your money in a Roth, that actually may be a better choice for you. And I want to explain why. So I'm going to take an example that, let's say you made $40,000 and every month you put $1,000 a month away in this workplace savings. That would mean, and I'm going to use as like an example of a teacher, we work 10 months. I was on a pay thing that was for 10 months. Apologize for the noise going on here. I'm outside of Las Vegas. I thought it was going to be a little quieter right now, but there's some noise. I do apologize for that. So I put away $1,000 a month. I worked 10 months. That is $10,000, a reduction in my salary. I made $40,000, reduced it $30,000, paid tax on it. But I've put $10,000 away that year. I also, if I was investing it in a Roth, would be doing exactly the same thing. I would still put my money away, make $40,000. I would then put $10,000 in my Roth. The difference is I am going to pay the tax on the year that I make that money. So I'm not reducing my income to $30,000 for tax purposes. I am keeping it at $40,000 and paying the tax on the $40,000 income, and then that money is still put away. The $10,000 is put away. So now let's fast forward. Let's say 10 years later, I have at least $100,000 put away for my retirement. In the tax shelter program, the first one I spoke of, I've not paid any tax. And my investment grew. So I'm going to say it was really in a wonderful, wonderful place, and it grew tremendously. And after 10 years, I now have $150,000 in my tax shelter program. In the Roth, I also have $150,000. Now let's say I never put another penny away. That's not going to happen. You guys aren't going to do that. But if I didn't put it away, I have $150,000 sitting in, if I put it in a tax shelter, and I have $150,000 if I put it into a Roth. What's the difference? When I do retire years later, and I begin to pull my money out of the tax shelter program, I will then have to pay tax. Now, because I have all of it put into one program, it says that's my retirement amount. So when it grew to $150,000, I now have to pay tax on the $150,000. I will never pull it all out at one time, but if I pull it out and $10,000, I'm going to pay tax on it, and I have to count that as income. So what happens with the Roth? I also have $150,000 if I put it in the Roth, same amount of money. But remember, with the Roth, I paid the tax when I earned the money. So the year that I earned that money, that $10,000, so if it was $40,000, I pay tax on $40,000. It might boost me a little bit up into a different tax bracket, probably not. That's a pretty low amount. So just remember, if you put money into a tax shelter program and that money grows, you will pay your tax on every bit of that tax when you pull it out. With a Roth, you never pay another penny in tax. You paid the money on the tax the year that you earned it. So who would do this? If you are somebody that your taxes are not very much because you're not a high income earner, go ahead and put it in the Roth, especially if you have a number of years that you can let that money grow through the investments that you have it in. It would probably make a lot of sense. If you are somebody in a high income bracket, you might want to consider the tax shelter program. If you're making $100,000 a year, you might want to shelter that. That's going to boost you into a higher income. But there are really people who make good money. There are other ways to shelter your money besides a workplace savings account. If you've got kids in college, if you have rental property, if you have a small business, there are other ways to do it and still put some of your money into a Roth. That's something that you need to discuss with an accountant, your tax person, whoever it is that helps you with that. But my purpose today of sharing the video is for you to understand the difference long term in putting money away in a tax shelter program or a Roth. And there's a huge difference. One other quick thing, in a Roth, you have no penalties, or you are never required to have to take your money out of the retirement. It is totally up to you what you want to do with that money. In a tax shelter program, at the age of 70 and a half, the government requires you to begin to take that money out because they haven't been paid the tax yet, so they want the tax from you. So hopefully this is giving you some kind of insight on maybe a plan for you when you do put your money away through a tax shelter or a Roth, the difference between those. The important thing is when you are working and you have the option to put some money away to save for retirement, you need to make sure you do it. And then make sure you pick the vehicle that works best for you. So I'll be back with some more tax information and some more retirement information from Sally, the retired teacher. Thanks for watching, and hope you catch me on the next video. Take care now.